getting out 6 months later. There's no time period going back into the 1870s that has made more money on a cyclical basis than buying now, and getting out about 6-7 months from now.
So October, this particular year, kind of tricked a lot of people because it never went down. We had a slight pullback, but we're right back where we started. But this month seemed to start off strong, and it appears that it's going to end strong.
Sure looks that way. Short-term trader went long yesterday, took some profits this morning, went right back alongside again today. So I think we're going to have a little rally in here. I'm still looking to position for the hedge fund that I run. I want some weakness in here, and it's when the next time we get oversold, I'm going to step in for my hedge fund and buy the right stocks, the quality stocks in the Dow Jones Industrial Average.
Now, in your hedge fund, are you dealing a lot mostly with, or not a lot, but are you dealing mostly with stocks, or are you also incorporating with the futures markets?
Strictly stock, strictly long-term, strictly value-oriented.
Okay. Do you still dabble with the futures?
Oh, yeah. I do a lot of short-term trading in the S&P 500 and the bond market, but for a longer-term perspective with other people's money, I'd just as soon buy and not have to get in and out and have every machination of the marketplace.
Okay. What do you think about what's going on in the commodity markets? In your book, you mention about commodities, and, of course, one of the oldest exchanges in the world, the Chicago Board of Trade. And you mentioned that that's where you'll find commodities such as corn, and I think you even give an example on corn, which is kind of, how many people want to really trade corn? But that market with the dollar seems to be moving quite actively now, and even soybeans, which just traded up to $8 for the first time in 67 years?
Yeah, we may see beans in the teens. So many people are focused on the stock market, not realizing that there's more dollar volume traded in that Chicago Board of Trade and the mercantile, that there's more action Chicago dollar-wise, that the cracking the money code is right there in Chicago, and there's some wonderful opportunities versus trying to buy these hot junk stocks that have no earnings and disparate management, who knows what, mismanagement, let's call it. There's no mismanagement in soybeans. They're real. There's real buying, real selling pressures there.
Right. Fundamental supply and demand forces. Because of this past summer, the weather had an effect that caused a reduction in supply. So a reduction in supply with either demand steady or higher demand, it's going to create prices to go up. It was kind of interesting that you mentioned that in your book, because this book came out about 3 months ago, and it just so happens you're predicting and calling for people to look at commodities. And if they didn't want to trade commodities or the price of corn or in grains, there's certain areas in the stock market that they could look to get into. So you really covered a lot of bases in this book. I mean, it's a fabulous book. In fact, one of your reasons, and you talk about looking into your crystal ball, it was about where our economy is going and with the amount of money and how we are in the business of taking care of people right now. And that's an interesting concept. Can you tell us a little bit more about that?
Yeah, I think as we have more discretionary income, and that continues to grow virtually every year, people used to work 40, 50 hours a week, and now we do work, but maybe not as many hours. There's so much more free time. That entertainment, travel, even now, post 9/11, I fly a lot, and the airplanes are always booked, and they're crowded, and just handling people's wants and desires is a huge business. Entertainment, whether it's sports or whether it's acting or music or art, it's big business.
Even the medical field in South Florida, with the retirees and just getting into the medical field, just all along, and it's so amazing how you pointed this out. But it's an entertainment. It's just taking care of people because of the masses, and it's not going to go away. Population is growing, and so we've got real estate moving. We've had a bubble in the equity markets, and you're talking that now they're starting to come back, and they're not going to do the mania that they used to. But your book more suggests that it's going to be more of an orderly kind of pullback, buy dips, and look for futuristic growth down the road, correct?
I would think so. Something like we saw in the 60s, probably, where we have growth from here to, say, there, 2007, 2008. The trend will be to the upside, but it's not a straight path to heaven. Mm-hmm. There's going to be up moves and down moves along the way, which mean the best investment policy is buy the big dips, sell the big rallies.
Well, I tell you, this is now, how many books have you written altogether?
I think this is the 8th book on market activity, and I've done a couple books on archaeological expeditions I've done.
Okay, that's right. You have been all over, and you just got back from doing a conference in Russia, I believe. So you're all over the world.
Yeah, Russia's really interesting. Very expensive, John. Sushi dinner, 2 people, $310. Thank you.
Wow.
Yeah.
So that's almost a point and a half in the S&Ps, or at least 150. You're going to have to really cover a nice trade in the Dow or in the bond market for that. So.
Yeah, I'm not a sushi eater, but some friends of mine went out and said, whoa, it's so expensive here. We were really surprised. And the cool thing was to see there was a huge economic conference there with 4,000 people, and the next largest conference only had about 350 people. It was the representatives of Russia for Mary Kay Cosmetics.
Oh, my God.
She's all over Russia.
She's
Cadillacs the whole deal.
Oh, no, come on.
Oh, the world's come so close together now.
Well, you're also you're living in San Diego, and you've escaped a narrow situation there with the fires. How is everything going there for you?
Well, it looks like most of the fires are out. Julian's still having problems, a really cool little mountain community, but the big ones in the metropolitan area of San Diego, Rancho Santa Fe, where I am, the Poway, San Bernardino, Rancho San Bernardino, whatever it is, area over by Poway, looks like those fires are out. But they're still around us, and they could catch up at any time, but it looks like these firefighting son of a guns have saved the day for us.
Well, Larry, I got to say, you've come back. You've also done a $1 million challenge, and we want to get. I would like to ask you if you would about that, how you do, folks. If you're not familiar, Larry Williams has put his money on the line in a $1 million challenge, and what he does is, if you attend these seminars that Larry's holding, the profits that he makes, he gives 20% back to the attendees at those seminars and conferences. We're going to take a break, Larry, and when we get back, mind if we ask you a little bit about that? And I also want to get back to more about your book, The Right Stock at the Right Time, because it's a stellar book, and it certainly is extremely reasonably priced and covers just a lot of material that I think every investor can benefit from. Is that all right with you?
I'll look forward to it.
Wonderful. Folks, when we get back, we have Mr. Larry Williams, and a trader extraordinaire and author of the book, The Right Stock at the Right Time. This is John Person, and we'll be right with you in a moment after this commercial break.
Hello, friend. Really good to see you once again. Hello, friend.
Welcome back, Larry. Larry, you've got quite a illustrious past. You've ran for Senate. Tell us a little bit about yourself. I mean, some people are familiar with you and others aren't, and we've got a stack of emails to prove that people have heard of you. But for those that aren't familiar with you, you went and ran for Senate a couple times in Montana.
I ran for United States Senate in Montana in 1978 and 1982. I was a Republican nominee. I started following the markets in 1962, and by 1966 I was trading full-time, and that's what I've been doing. And I've gone from a little longer-term viewpoint to personally now short-term trading.
Mm-hmm.
Though as we mentioned earlier, I do run a hedge fund.
Okay.
That's longer-term. That's more like money for my latter part of my life. But I'm actively trading in the market. I was in and out of the market the last 3 days doing the $1 million challenge here in San Diego, Rancho Santa Fe. And I trade. I mean, I really do this stuff in pretty decent size.
Now, how can people find out? Are you going to do more of these $1 million challenges?
I don't know. The goal is to make $1 million in a series of seminars of real-time trading. And the last 3 days, I think we're going to net out about maybe $35,000, which puts us real close to making the $1 million. I think we'll be at $980,000 in real-time trading in, 10 seminars, something like that. So I may yet do one more to hit the $1 million mark and say, hey, look, we did it 3 days, series of seminars and made that much money real-time trading.
And you're giving 20% back to the audience. So you're going to give back $1 million of the market's money. You're giving back $200,000 to attendees of your seminar event.
That's right. I so many people talk about what to do, but I don't see them pony up to the bar and say, hey, plunk down and buy 10, 15, 20 S&Ps or 20, 30 bonds. And I do that stuff. And I like to teach people how to do what I do.
And in the methods that you use, they're not in this stock book, but a lot of the principles you do use that are in this book that you're
Well, yeah, the basic principle, I think, is that fundamentals matter. So many
Right.
people are just technical analysts, and they look at wings and widgets, and they try to have chart patterns explain the past to predict the future. And I don't go for most of that. I think that markets move for reasons, and I try to get inside the markets to see what those reasons are. And take my trades. They don't all work out, so I use stops. If I'm out, I'm out. And if I'm right, I try to let those profits run.
Larry, we have a bunch of questions, but first
Great.
off, before we get into the questions, And again, folks, if you want to ask questions, and if I use your question, I'll mention your name on the air, and we'll send you a Chicago Board of Trade Mini Dow trading shirt as a courtesy for participating. And you get an opportunity to voice your opinion and ask the questions to the experts, such as Larry Williams. And Larry, if people want to learn about this $1 Million Challenge, because that's like you said, you put the money where your mouth is. People can attend these seminars. They can learn your methodology, watch you actually trade in the course of 2-3 days. And, as you make money, some seminars may make more than others depending on trading conditions. But you give 20% back to the audience, correct?
That's correct.
Now, how would they find you? Is that your website is www.commoditytiming.com, right?
Right. That's a great way to get in touch with me.
All right. COMMODITY timing, TIMING.com, correct? CommodityTiming.com for Mr. Larry Williams to find out more about the $1 Million Challenge. And is your book on that website?
I believe that it is, or Amazon.com. That's where I buy mine.
Okay, so Amazon.com to go buy the right stock at the right time, prospering in the coming good years. Larry, in the early 80s, commodities were moving just as they were in the 70s, and you had a phenomenal claim to fame. You took $10,000 into $1 million. And I'd like to say, do you find that achievement you've been able to do again, or is it that you just trade in a different style, or do you find the markets are a little bit different than they were in those days?
Well, the markets are always different, but yeah, as we talked about in the $1 Million Challenge, I think we've done maybe 10, 11, 12 seminars, something like that. Each seminar is 3 days, and we've made just about $1 million in that series of, 35 trading days, something like that.
Okay.
The 3 times 11, whatever that is. So
right.
There's proof of it. And then, of course, my daughter, when she was 16, I taught the trade, and she went on to win the Robbins World Cup Trading Championship, taking $10,000 to $110,000. That same year, I made $1 million trading. So, I think people have this knowledge, or this notion that if once you make $1 million and you give it all back, well, maybe some of them do.
Well,
I haven't.
There's an old saying that success breeds success, and so obviously you've been able to give that Midas touchdown to your daughter.
Well, not all my trades are winners too. Let's be clear about that. Yeah. This is one tough, rugged business.
Yeah, it's run tough, but you show consistency. It's not that you put one trade on and let it run, and it's $1 million and you walk away. You're done for the year.
Right.
This actually takes work. You manage these trades.
Run it like a business. It's not a crapshoot of putting all your eggs in one basket and hoping that one big trade comes along and makes you the wealthiest man in America. This, to me, is a business that I do of being a trader.
If I could ask you, Larry, it's now about 6:25 Eastern Standard Time. You're in San Diego right now, and it's about 3:25 out there. What time have you been up? Since what time have you been up today?
About 2:30 this morning.
So you've been up since 2:30 this morning working. You've come and you're giving your time to us, and hopefully people are listening and taking careful notes with this, because you are a hard-working individual. And it's not just that you've traded, you've made money trading, you've made money realistically trading, and you've got witnesses in the last seminar. So you're continually setting yourself a pace, and you have a set plan every day, it seems like.
I do, yeah. I know what I'm going to do tomorrow in the S&P and the bond market. I know that right now. And I think that may be one difference, because my stuff is mechanical.
Okay.
So I don't have to say, oh, well, is this line coming in or that line, or what do I feel, what's the news, what does my broker say? I mean, I know what I'm doing. I have a plan of action.
Well,
and I do it.
Now we're going to get into some questions, if that's all right with you.
Great, let's do it.
All right. Now, one of the questions was, we had an individual who did not give his name on his email, but his email is a bunch of numbers, who wanted to know what the best method of trading. Is it mechanical trading? And is that the method that you use?
The best trader of them all right now is a guy named Steve Cohen, maybe the best trader ever. Steve is semi-mechanical, as I understand it. That works for him. Me, I don't have enough confidence in my judgment. I need a mechanical system. I think you have to find what fits you. And to say, oh, there's only one be-all, end-all system or approach, I think you have to find what works for you. I found what works for me. I can teach that to other people. They adapt it, twist it around so it fits them. You have to get it so you're comfortable with it yourself.
Okay. Here's a question. Jim Welsh, same topic. The question pertains to Larry's opinion of mechanical trading systems. What does Larry trade any pure mechanical trading systems? I think you answered that, yes. And what is your opinion of mechanical versus the intuitive trader, one who knows what he thinks he is doing?
Well, I prefer mechanical because I can control my risk. When I'm intuitive, I don't know for sure where I have to get out. But in a mechanical system, my risk-reward ratios are pretty well ascertained in advance, so I can manage my money, which is really how you make money. You have to have some money management formula to do it. So I like the mechanical approach because I know where to get in, where to get out. There's no guesswork. It's much more business-like than, what do I do today?
Please ask Larry where he puts his stops on the Darlings of the Dow picks.
The Darlings of the Dow are my fundamental selection. Let's review just a little bit where I buy those usually around the end of October. These are the best value stocks in the Dow Jones Industrial Average based on price to sale, projected earnings growth, and 12-month forward PE. When I find those 5 stocks, you know what? I buy them, and I don't use a stop. All of my testing, which goes back to 1976, so you should buy those stocks and hold them for about 9 months. Your average return on that is about 22% without a stop. And that's what I do. I buy them, get out 9 months from now, and trade's over.
Larry, we got a stack more questions. Thank you very much for answering that one. And when we get back, we're going to ask some more questions, and we have a surprise guest. I don't know if you were told, but you had an old trading partner that you used to do seminars with many years ago. His name is Jake Bernstein. The two of you, both Larry Williams and Jake Bernstein, have pretty much a space right there when it comes to creators and innovators of technical analysis, because you've both invented indicators and you use those indicators. We're going to bring Jake on after we have a few more questions right after this commercial break. How's that sound to you, Larry?
Oh, I look forward to that.
Wonderful.
That'd be great.
Yeah, wonderful. Larry, thank you very much. Just hold on with us, folks. We'll be right back with Larry Williams and a special guest, Jake Bernstein, in just a moment.
Hello, friend. Really good to see you once again. Hello, friend.
Welcome back, everyone. With me tonight, my special guest, Mr. Larry Williams. Larry, welcome back, sir.
Thanks so much, John.
Oh, no, thank you. You've written a fabulous book, The Right Stock, at the right time. You've just got back from a trip from Moscow. You've just done a 3-day trading expose showing the $1 Million Challenge, showing people how to make money, which was successful. You're up $35,000 on that get-go, almost hitting that $1 million mark. And you're sitting in an area where the world's on fire in San Diego, and you have time to visit us. And I tell you, Larry, we really want to say we're grateful, and I hope my listeners tonight are paying attention, because we have one more surprise. Before we went on break, I announced that we have a surprise guest for you. It was a person that you used to conduct seminars with, Mr. Jake Bernstein. Before we bring Jake on, because I'd like you two to talk about short-term indicators, I want to go through a few more questions that some of your people, fans, and listeners have sent in for us. First off, we have this is just from Lewis Brabley, who saw you at the Palmer House. He can't remember what year. He just wants to say, what say you, Larry? How you doing?
Hey, I'm doing great. I'm getting old like everybody. A little wiser. I don't know if I'm any smarter or not, though. I remember those days. Those were great days.
In fact, he said this was a commodity trading conference at the Palmer House Hotel in Chicago, where you and Jake were at. How about that?
Oh, that was a long time ago. That was a great experience. You bet.
And now we have someone who just wants to say thank you to him on air from Pietro Grala, who sent this in from Poland.
Wow.
So his if my English was wrong, it's because I was reading directly. I'm Polish, and I have more than 6 years trading futures, and he says that you've done a tremendous job, and he wants to say thank you. And here we have some more questions, a couple more that we would like to get through.
Right.
First off, is your OOPS pattern still effective?
Yes, it is. I took a profit today in the gold market on an OOPS signal, about $350 per contract. I had one contract on in the trading seminar. It was one of our trades. Did it today.
Okay. Well, for those who aren't familiar with the OOPS, could you give us a quick rundown on what the OOPS signal is about?
Basically, what I look for, John, is a market that opens below the prior bar's low if I want to be a buyer. And then if it runs back up to the prior bar's low, I buy at that price on a stop. And I would like to have some other backing of fundamental consideration or something going on to confirm the trade. But that's it, and it's really it's a real good short-term entry technique in the market when the conditions are right for it.
How did you name that the oops indicator, if I could ask?
Well, sure, Don. What happens? The market opens down below yesterday's low, and brokers call up their customer and they say, oops, we're in trouble here. And then they sell it, the market goes down, it reverses and turns back to the upside, gets above where I bought it, and they call back, and then they then say, oops, we did the wrong thing again, and then they start buying, and that buying causes more of a rally in the marketplace, which gooses my long position, hopefully up even a little bit higher. So it's really the error of people selling a lot of weakness, and it gets reversed, and now they're in a bind. They got to cover those shorts, and that causes more buying in the marketplace, higher prices.
Okay. Does that pattern work best in T-bonds? Will it work in mini Dow or something? Is it something that will apply to all futures and stock markets?
Interestingly enough, John, I've used it in China, in the markets in China when I've traded there. I've traded the markets in Singapore, in Australia, in Russia with it. It works in virtually all markets.
Okay. Any insights into your applications of the Williams percent R, and how has that changed?
Oh, it's a great tool. I developed it in 1966. But what's changed about it, I think, is my understanding. What's really important with my oscillator, or anybody's oscillator, is to put it in conjunction with the overall longer-term trend. So if we see the market is in a big downtrend, then I only want to take the percent R sell signals. If it's in a big uptrend, then I only want to take the percent R buy signals. And that's really critical that you're in phase with the trend of the market itself.
Okay. Edwin Ardrey wants to know, how is the MACD, moving average convergence divergence, technical indicator best utilized, and is it one of your favorite tools?
Well, it's one that a good friend of mine, Jerry Appel, developed. It's a real nice tool. It shows the momentum of the marketplace. I don't use it much, but if I wanted to see as momentum picking up or declining as we rally, then I'll look at MACD. But I personally, it's not an indicator I use, but I know a lot of people have had great success with Jerry Appel's indicator.
Yeah, Jerry was on our show a couple months back, and
he's a super
absolutely
trader.
Gave a great example about a divergence in MACD on the bonds when they were at their top at around 124. But we're going to break for commercial. When we get back, our questions are pretty much through, Larry. You survived that, did a great job. Thank you. But now we have our guest, Mr. Jake Bernstein, we're bringing on. We're proud to see the two of you. And this is, how long of a reunion has it been since you guys been on together?
Oh, gosh. Jake and I first met, I think I was 13 and he was 12.
Oh, my God.
That's
okay.
a long time ago. Must be 20 years at least.
All right, but you're coming back tonight on tonight's show as a special reunion. Folks, when we get back from this commercial, Jake Bernstein with Larry Williams. We'll be right back.
Hello, friend. Really good to see you once again.
Well, I don't know which old friend we've got. We've got two old friends, Mr. Jake Bernstein joining us with Mr. Larry Williams. And the two of you haven't been together on a show in how many years has it been as this reunion taking place here?
Oh, I think Jake and I are probably together maybe 3-4 years ago, something like that.
3-4. Well, welcome aboard. Jake, are you there?
I sure am. Hello. Hi, Larry. How are you?
Jake, I'm old and uglier than I was the last time you saw me.
Well, that must be pretty bad, Larry.
It does.
Well, guess what? You're not the only one. I'm old and uglier, too.
Good.
Well, I stay youthfully young, so I'm not in on this party. Anyway, guys, we had two living legends. Seriously, I mean, you think about it. I mean, Larry, you contributed so much to technical analysis with, and just before we went on break, you talked about percent R, and Jake, you've got 30 some odd books out there. You've created a few indicators yourself. You've got a lot of things going on, and the two of you really helped complement each other in trading styles in the early 90s and the late 80s. What do you say we get into comparing some of the short-term indicators that both of you use? How's that?
Sure, let's go for it.
Okay, but I want to ask, while I have you on the phone, I'd like to ask both of you a question from Fred Lee. This would apply for both Jake and Larry. How do you use a trade? First, we'll go with Larry. Larry, how do you use a trailing stop loss, and under what conditions?
Well, I like to use a trailing stop loss once the market is broken out of congestion. When it's in congestion, my stop is quite a ways below the market. Once it breaks and starts to run in my favor, then I ratchet that stop loss up a little closer, usually under the lowest low of about the last 3 or 4 days.
Okay. Jake, how do you feel about that question?
Trailing stops are rather tricky because most people want to have their trailing stops way too tight.
Okay.
If you're going to have a trailing stop that's way too tight, you will get stopped. You might as well just get out. If you're going to use a trailing stop, it has to be a wide trailing stop, by which I mean lock in no more than 50% of your profit as a trailing stop. But I think you're much better off getting out using indicator-based stops as opposed to strict money management stops.
Okay, very good. And Larry, do value areas, up value, low value, and pivot have any significant meaning for day trading E-mini, say the Dow, or bonds? And that comes from Amy Waldman.
Yeah, Amy, I don't think they have as much value as people assign to them, or maybe I was just never smart enough to figure them out. What I like, though, is if we open below what they call the projected low. That's something I wrote about in my book in 1966, now called Pivot Points. If we open below the projected low and come back to it, that's usually a pretty good buy signal. But I think you draw enough lines on a chart, or it's going to look like something's happening there, even though nothing was really going on.
And pivot points is very widely used and something that I even do lessons and teach on. And it's if you take the high-low close, divide by 3, you get the pivot point, and you can figure out the rest of the calculations for support and resistance numbers. Here we go. Is that what you're referring to, Larry?
That's absolutely it.
All right. Now, I've got another question. This is kind of a long one, so I need both of you guys to participate with this one, please. This particular individual knows that short-term trading of large S&P contracts has been very valuable for some time, but they'd like to know if there are any other markets that offer as much bang for your buck as that particular market. For example, bond futures, mini Dow futures, and NASDAQ futures. Also, in evaluating that market, do you utilize any particular tools to identify the possibility of increased volatility? That's an awful long question, a lot there. If I could, I'll jump in.
Let Jake have that then.
All right, Jake.
Thanks a lot, Larry. All right. First of all, I happen to love the bond market. I think the bond market's great. I think you get a lot of bang for your buck in the Dow futures as well. S&P, hey, that's a big contract. A lot of people cannot trade that contract. E-mini is a great market too, but it still requires a lot of margin. But for my money, the bonds are a great market. As far as volatility is concerned, yeah, there are quite a few volatility tools out there, but my view is I try to go strictly with established seasonal tendencies. In other words, certain times of the year when bonds tend to do certain things. I combine that with timing, and if my timing is right and my seasonal is right, the volatility takes care of itself.
Well, who learned from who? Because, Larry, that sounds very similar to what you wrote in your book, The Right Time at the Right Stock.
Well, I agree with
The
Jake.
right stock at the right time. Excuse me. I'm sorry.
When you look at the margin requirement, bonds are real volatile, and the margin's only $3,000 or $2,800, something
right.
like that. T-notes even a little less. So you got a lot of bang for your buck there, which is what the listener is looking for, and a market that has pretty decent predictability to it.
Here's one last question that we got, and then we've got to really, I want to sit down and drill both of you guys on your short-term indicators in trading, if I can. The question here, besides the deficits are high, accounting firm scandals, and manufacturing and jobs overseas, corporations are moving them, the market is rising today. But is the market, and he's referring to the stock market, but is the stock market overbought? Are we in a rising bear market or the beginning of a bull market?
Can I take that one?
I'll let you both take it.
All right. Larry, you want first shot?
Go ahead, Jake.
I think this whole idea of overbought, oversold is absolute nonsense. I think a lot of traders have been sold a bill of goods by believing that things can be overbought. Things are going to go where they're going to go. A lot of people didn't want to buy the market when it was supposedly overbought. 6 months later, it's more overbought. Then it gets overboughter, and then it keeps on getting overbought. Markets climb a wall of worry. As long as the news is bad, people don't want to buy. However, the market keeps going up. You got to ask yourself, hey, what's going on? It's a very simple process. So, no, I don't think the market's overbought. Keep the news bad. As long as the news stays bad, the market will just keep on going. As soon as the news gets too good, people will jump on the bandwagon. Prime opportunity for professionals to unload their positions on an unsuspecting and gullible public.
Jake, thank you very much. Larry?
Well, I would change the terminology to overvalued or undervalued, and currently stocks are about fair value. If you look at the 12-month forward earnings on the Dow Jones Industrial Average, and that's what the Federal Reserve looks at, there's a multiplier factor that tells us what growth should be over the next 5 years based on that, which has been really deadly accurate in predicting future growth. And we're currently right about where we should be. We'll have growth over the next 4 or 5 years at about 4 to 7%, which is somewhat typical for stock prices, not counting a dividend. So we're certainly not way overvalued. If we look at the 12-month forward PE ratio of the Dow stocks, we're in a relatively good value, not a bargain basement value, but we're not overvalued in terms of the value ratios of the Dow Jones average itself.
Okay, wonderful. Gentlemen, we have a commercial break. We get back. We have the dueling banjo contest about Jake Bernstein and Larry Williams, our special guests tonight on short-term indicators and how they apply them in trading. Gentlemen, we'll be right back. Folks, join us, will you? Thank you. This is John Person, your host.
Welcome back to the Personal Investors Hour with John Person. And now, here's John Person.
Welcome back, everyone. With me tonight, my special guests, Mr. Jake Bernstein and Larry Williams, author of the latest, hottest book on investing called The Right Stock at the Right Time. Prospering in the coming good years is what we've been talking about. And Larry's outlook is looking bullish overall up until, and I believe we discussed this in the first half of the show, 2009. Was I paying attention, Larry?
You were.
Thank you very much. I get an A today. Great. Gentlemen, we've answered a lot of questions from people, and I missed one, but I think I have to ask this because I know we're into the section of the show where I wanted to do the dueling banjo contest of getting both of your opinions on short-term indicators that you use to trade. But this question stands out. I got to ask it. Larry, this one's for you. You ready?
I'm ready.
One of Larry's, this is from Gardner Bartlett. And Gardner asks, one of Larry's early books discussed using the moon as a broad general indicator. Has his opinion on that changed much over the years?
Well, you don't want to write books about moons influencing commodity prices and run for the U.S. Senate in Montana because the dirty dog opposition will bring that out and say, look how kooky this guy is. Not only does he trade pork bellies. So be careful what you write in a book. But, I think it's an academic interest. It has some influence, not a lot. But a little bit. Nothing I can make a systematic trading approach out of, but there is an influence there. Yeah, it's marginal, but it's there.
Yeah, but I think it also has to do with a lot to do with cycles, and that's a whole other thing. And
could
folks,
well be.
If you want more information on Larry Williams, please, by all means, visit his website. It's commoditytiming.com. That's COMMODITY. timing.com, commoditytiming.com. Larry Williams. And Jake's probably one of the top guys on seasonals and cycles. And Jake, you can find Jake at trade-futures.com. Let's get into it. Short-term indicators. Larry, what do you use? And how do you use it?
I like to use market patterns as opposed to indicators.
Okay.
Unless I would use my percent R as a short-term to go against the trend of a longer-term move. Longer-term down is down, then I want to take percent R sell signals.
What's your favorite patterns? Give me your top three.
Oh, gosh. A favorite pattern would be a day that closes below the prior day's low, has a large range day, opens down the next day. I'm looking to be a buyer of that real strong weakness.
Okay. Not a pattern per se like a head and shoulders
or
no.
I'm talking about patterns with 2 or 3 days market price activity.
Okay. So you're talking within, and you use mainly bar charts, correct?
That's correct. I don't like candlesticks and all
You're
that.
not a candlestick man?
Yeah, not at all.
Okay. Jake, short-term indicator, your turn.
I would have to agree with Larry. One of the things that I really saw the light when Larry started using patterns many years ago, I couldn't agree with him more. There are some really great patterns, and these are patterns based strictly on relationships between open, high, low, and close over a period of days. One of my favorite patterns is what I call the Friday-Monday relationship. This relationship occurs primarily in stock index futures, where if on Friday you close higher than where you opened, you're a buyer on Monday above Friday's high. If on Friday you close lower than where you opened, you're a seller on Monday below Friday's low. That pattern occurred this week. On Friday last, we closed higher than where we opened. We penetrated Friday's high on Monday, and we got out on Tuesday on a very short-term profit.
Okay. Larry, other short-term indicators?
If I'm buying a buyer of the S&Ps, I want to see what the direction of the bond market is. And the bond market's in an uptrend. Virtually all technical S&P signals on the buy side work better. If you want to be a seller, make certain bonds are in a downtrend, and then all of your sell signals work better.
Okay. Jake, do you follow that systematic approach as well?
Yeah, I like that. Another thing I like to use is momentum.
All right, let me interrupt here. This isn't fair, guys. You guys work together. You use very similar techniques, and you're both very successful. So I'm obviously not getting much in the dueling banjo, am I?
Well, you know what, Larry and I think we complement each other quite well. Larry's got some great patterns. He's got some fantastic stuff that he uses. We don't always find ourselves agreeing on what's going to happen, but we still usually land on our feet or better.
Well, and I think the interesting thing, Jake, is that everybody's got to find what fits them, and Jake's found what works for his mind, his lifestyle, his temperament, and vice versa. You can't be me. This idea of you can model somebody and be just like them. You got to find how it fits you. My shoe isn't going to fit Jake, and vice versa.
That's right.
Great point.
That's very true. Our friend George Lane many years ago developed stochastic. It was a great indicator for him. A lot of people have done well with it. I can only use stochastic in one or two specific ways. I can't use stochastic and benefit from it in the way that most people do. So Larry's right. You have to develop your own style based on what's out there, and there's so much out there to choose from. Unfortunately, a lot of it is worthless, and that's why you have to go and do the research and get the information on your own.
As both of you may know, I worked for George for 2 years back in 80 through 82, so I can testify that stochastics works for some and not others.
Exactly.
Jake, you came out and you mentioned something about a momentum indicator. We've got like 30 seconds. Can you...
What you want to do is you want to see momentum moving in the opposite direction of price as a trigger, as a setup for a trigger. I like to look at trades in terms of three aspects: setup, trigger, and follow-through. So when you've got momentum moving up, price moving down, you need to look for a trigger. Market's going to go down. Momentum moving up, price moving down, you want to look for a trigger to get you in on the long side.
I got one thing to say for both of you. We're running out of time. Folks, Larry Williams, CommodityTiming.com. Jake Bernstein, thank you for coming on and being a surprise guest. Really was tremendous of both of you, especially Larry, dealing with the fires that you have. Folks, go to their websites or get a hold of me through nationalfutures.com. Next week, we'll be here. We hope you are. Thank you, gentlemen.
Thank you. Great.
This has been the
Nice being with you, Jake, again.
Investors Hour.
The content of this program does not constitute investment advice. This program is to help enlighten you to the opportunities for further education and trading techniques by industry leaders. It should not be considered as a solicitation to buy, sell, or invest in securities, options, or futures. Remember, trading does involve the risk of loss. Past performance is not an indicative of futures results. Futures and options is not suitable for every investor. Please consult a professional regarding your financial situation before placing a trade.